What happens when the most powerful financial institutions in the world realize they're about to lose everything? They don't accept defeat, they rewrite reality. And that's exactly what happened last night while you were sleeping. This isn't a conspiracy theory, this isn't speculation. By the end of this video, you'll see the documented evidence of the biggest market manipulation event in modern history, and you'll understand why the next few weeks will determine the future of the entire financial system. Let's start with what actually happened. Monday was supposed to be a day of celebration for silver investors. The price had broken through resistance levels that analysts said were impossible to breach. Silver crossed $75 per ounce, and the momentum was undeniable. Traders around the world were watching their screens in amazement as decades of suppressed prices finally gave way to market reality. But while retail investors were celebrating their winning positions, something very different was happening behind closed doors. Late Monday night, emergency meetings were convened. Exchange officials gathered with the heads of major bullion banks in urgent sessions that lasted into the early morning hours. These weren't routine risk management discussions. These were crisis meetings. The problem they faced was simple but catastrophic. Their mathematical models, the sophisticated algorithms that track price movements and calculate risk exposure, were all showing the same thing. If the current trajectory continued, silver was heading straight to $100 per ounce. And at that price level, the losses on their short positions would exceed their capital reserves. In plain English, they would be bankrupt, so they had a choice to make. Option 1, honor their contracts, accept their losses, and face potential insolvency. Option 2, change the rules of the game in the middle of play. They chose option 2. At exactly 3:00 a.m. Eastern Time, a notice appeared on the exchange website. There was no announcement on financial news networks. There was no press release sent to media outlets. There were no tweets from official accounts warning traders of what was coming. The rule change was simply posted in a technical update section of the website, where most retail traders would never think to look, especially not at 3 a.m. The rule change itself was devastating in its scope. They declared a margin requirement increase of unprecedented scale. To understand what this means, you need to understand how futures trading works. When you trade futures contracts, you're using leverage. You put down a deposit, let's say $10,000, and that allows you to control a position worth many times that amount. This system of leverage is what makes the futures market accessible to individual traders and allows for efficient price discovery. But here's where it gets sinister. The rule change enacted in the dead of night effectively doubled the amount of cash required to hold an existing position. Think about what that means for a moment. Imagine you bought a house last week. You signed all the contracts. You put down your deposit. The deal is done. Then imagine the next morning the bank calls you and says, "We've changed our policy. You now need to deposit an additional $50,000 in cash by noon today, or we're going to seize your property and sell it to cover our losses." That sounds illegal, doesn't it? That sounds like theft. But that's exactly what's happening to thousands of traders right now. They're being hit with margin calls, not because the price of silver dropped, not because their positions are losing money, but simply because the exchange changed the rules overnight. They're being forced to either come up with massive amounts of additional cash immediately or liquidate their winning positions at whatever price the market will give them. This creates artificial selling pressure. When thousands of traders are forced to sell at the same time, prices drop. That's basic supply and demand. But this isn't natural selling pressure from traders who want to exit their positions. This is forced liquidation created by a rule change designed specifically to generate downward price movement. The exchange is manufacturing a crash to save the banks from insolvency. But the margin requirement increase was just the first wave of their attack. We're now receiving reports from multiple brokerage platforms that the buy buttons are being disabled or restricted for silver contracts. If this sounds familiar, it should. This is the exact playbook they used during the GameStop situation in 2021. Traders attempting to purchase new silver contracts are encountering error messages. Risk management limit reached. Trading restricted to liquidation only. System maintenance in progress. These aren't technical glitches. These are deliberate restrictions. What these messages really mean is simple. You're allowed to sell your silver to the banks, but you're not allowed to buy more from them. Think about the implications of this. In a functioning free market, buyers and sellers meet voluntarily to determine price. But when you remove the ability to buy while keeping the ability to sell, you've destroyed the market mechanism. The price can only move in one direction, down. This isn't a free market finding equilibrium. This is a controlled demolition of the price, engineered to allow banks to cover their short positions at artificially suppressed levels. What we're witnessing is market manipulation in its purest and most blatant form. It's not hidden behind complex financial instruments. It's not buried in regulatory fine print. It's happening right out in the open, and the regulators who are supposed to protect market integrity are looking the other way. While retail traders are restricted from buying, the banks are unleashing their own algorithms to paint a false picture of market conditions. This morning, we witnessed massive sell walls appearing on the order books. Suddenly, blocks of 5 million ounces appeared for sale at $76. To a retail trader watching their screen, this looks like massive selling pressure. It looks like everyone is trying to exit their positions. It creates fear. But here's what you need to know. These orders are fake. This tactic is called spoofing, and while it's technically illegal, it's also incredibly difficult to prove and prosecute. The banks place enormous sell orders on the books to create the appearance of overwhelming supply. The price starts to drop as other traders see these massive orders and panic. Then milliseconds before these orders would actually be filled, the banks cancel them. They never had any intention of selling. They just wanted to create fear and trigger stop losses. This is market psychological warfare. They're gaslighting the charts. They're trying to convince you that everyone is selling, that the rally is over, that you should cut your losses and get out. But in reality, demand is stronger than ever. The physical market tells a completely different story than the paper market they're manipulating on your screen. We need to talk about the exchange itself because this is where the corruption runs deepest. The exchange is supposed to be a neutral referee, ensuring fair play and orderly markets. But here's the problem. The exchange is owned and controlled by the very banks it's supposed to regulate. The board members are former executives from the same institutions that hold massive short positions. When they declare a rule change, they're not protecting market integrity. They're protecting their friends' balance sheets. By raising margins and restricting trading, the exchange has violated its most basic obligation to the public. They've proven beyond any doubt that the paper market isn't a place for honest price discovery. It's a rigged casino, and when you start winning too much, they simply kick you out and keep your chips. The legitimacy of this exchange died this morning. They've sacrificed whatever credibility they had left to save the solvency of the banking cartel. History doesn't repeat, but it certainly rhymes. In 1980, the Hunt brothers accumulated massive silver positions, driving the price to $50 per ounce. The banks were facing total collapse. Their losses were mounting by the hour. So the exchange did exactly what they're doing now. They changed the rules. They declared something called Silver Rule 7, which stated that traders could only sell their positions, not buy new ones. With buy pressure eliminated and forced selling accelerating, the price crashed from $50 down to $10 in a matter of weeks. The bank survived. The Hunt brothers were destroyed. They're using the exact same playbook today because they think it will work again. But there's one critical difference they haven't accounted for. In 1980, the demand for silver was primarily speculative. Traders wanted exposure to silver as an investment, but they didn't actually need the physical metal. Today, the demand structure is fundamentally different. Silver is no longer just a precious metal for investment. It's a critical industrial commodity. You cannot tell Apple or Tesla that they're restricted to liquidation only. These companies need physical silver to manufacture solar panels, electric vehicle components, smartphones, and countless other products. The world economy runs on silver now in ways it didn't in 1980. The rule changes might scare speculators into selling their paper contracts, but they cannot stop industrial consumption. They cannot stop the solar industry from needing silver for photovoltaic cells. They cannot stop the automotive industry from needing silver for electrical contacts and circuits. The banks are fighting a war against physics and supply-demand fundamentals, and physics always wins. The most damning evidence of their manipulation is the growing spread between the paper price and the physical price. While the banks manipulate the digital numbers on your screen, the real world is telling a completely different story. If you try to buy a physical 1,000-ounce bar today from an actual bullion dealer, you'll find they're charging premiums of 40% to 50% over the spot price. Some dealers have stopped quoting prices entirely and are asking customers to call for availability. Why would physical silver cost so much more than the paper price? Because the spot price is fake. The paper price is a fiction agreed upon by institutions that have no intention of ever delivering physical metal. The real price is what you actually have to pay to get silver in your hand, and that price is far higher than what the exchange claims. This disconnect proves that the paper market has become irrelevant for actual price discovery. The banks can smash the paper price down to $50 or even $40 if they coordinate enough selling pressure, but they cannot make physical silver appear in dealer inventories. They cannot fill industrial orders that require actual metal delivery. The market is bifurcated into two separate realities. There's the banker's fantasy price, and there's the real price that people pay in the physical world. Traders need to understand what's coming next, because this crisis is about to escalate further. Buried deep in the exchange's user agreement is a clause that most people never read. It's called force majeure, and it gives the exchange the power to void contracts in the event of an emergency. If the price of silver continues rising despite all their manipulation tactics, they will likely invoke this clause. Here's how it will work. They'll declare that, due to extraordinary market conditions, they cannot fulfill delivery obligations. They'll say there isn't enough physical silver available to satisfy all the contracts, and they'll offer you a cash settlement based on a price they determine, probably using yesterday's manipulated closing price as the reference point. This is legalized theft dressed up in legal terminology. It transforms your property right, your claim to physical silver, into a paper claim that they can settle for whatever amount they decide is appropriate. They're already preparing the legal framework to default on their obligations. They know the vaults are running low on inventory, and they're writing the rules that will absolve them of liability when the inevitable shortage becomes undeniable. Where's the outrage? Where are the investigations? Where are the regulators who are supposed to protect market integrity? Turn on any financial news network right now, CNBC, Bloomberg, Fox Business, The Wall Street Journal. You'll hear nothing about what's happening. The biggest market manipulation event in modern history is taking place in real time, and the financial media is completely silent. They're not reporting on the margin hikes. They're not investigating the disabled buy buttons. They're not questioning why physical silver costs 50% more than paper silver. Instead, they're publishing dismissive articles calling silver a meme stock or a dangerous bubble driven by social media hysteria. They're doing everything possible to make this look like irrational retail speculation rather than a fundamental supply shortage, meeting institutional manipulation. This coordinated media silence isn't accidental, it's purchased. The major banks are among the largest advertisers on these networks. They provide analysts for commentary. They sponsor entire segments. The media depends on bank advertising revenue, and the banks are now calling in those favors. They're controlling the narrative to keep the broader public unaware of what's really happening. They want everyone to think the price movement is natural market forces, not engineered crisis management. So why are they going to such extreme lengths? Why risk their reputations, potential criminal charges, and public outrage? Because one specific bank is trapped in a position that threatens its existence. JP Morgan holds the largest concentrated short position in the history of commodity markets. According to data from the Commodity Futures Trading Commission, their exposure is measured in hundreds of millions of ounces. If silver reaches $100 per ounce, the mark-to-market losses on their short book will exceed their Tier 1 capital requirements. In simple terms, the bank becomes insolvent. This isn't about losing money on one bad trade. This is about the potential failure of a systemically important financial institution. That's why regulators are allowing them to cheat so openly. The Federal Reserve knows that if JP Morgan fails, the contagion spreads instantly. Counterparty exposures would trigger a cascade of failures across the entire banking system. They've determined that JP Morgan is too big to fail, and they're giving the bank whatever tools it needs to survive, even if that means rigging the silver market. We're not fighting against one bank or one exchange. We're fighting against the combined power of the state apparatus and the financial elite who control it. But there's one major player who doesn't follow American rules and doesn't care about Wall Street's survival. China operates the Shanghai Gold Exchange, which functions completely outside the jurisdiction of the American regulatory system. Chinese officials are watching this manipulation in real time, and they interpret it as weakness. When Western banks suppress the price through paper games, China accelerates its physical buying. They're using the artificially low prices to drain the West of strategic metal reserves that took decades to accumulate. The Chinese government actively encourages its citizens to buy gold and silver through state media campaigns. They're accumulating the physical metal while the West plays with digital contracts and empty promises. By cheating to survive today, American banks are inadvertently transferring real wealth and strategic resources to the East. They're selling their industrial future for short-term survival. The rule changes are also creating serious problems with industrial users of silver. Major manufacturers like Samsung, Tesla, Sony, and Panasonic rely on the futures market to hedge their material costs and ensure stable supply chains. When the exchange manipulates prices and changes rules arbitrarily, it destroys the ability of these companies to plan their production and manage their costs effectively. We're hearing credible reports that major industrial buyers are abandoning the exchange entirely. They're establishing direct supply agreements with mining companies, cutting out the paper market completely. This represents the death of the exchange's relevance. If industrial users leave and only speculators remain, the exchange becomes nothing more than a gambling parlor with no connection to physical reality. The banks made a critical miscalculation in their strategy. They assumed that by crashing the price and changing the rules, they would scare retail investors away. They thought you would panic and sell, that you would doubt your analysis and cut your losses. They expected the same reaction they've gotten for decades whenever they've suppressed prices. But instead of creating fear and capitulation, they've created rage and determination. The forums and social media channels are exploding with angry investors who now fully understand they're not participating in a free market. They're participating in a rigged game, and that realization is radicalizing them. Rather than selling their positions, investors are doubling down. They're pulling money out of the manipulated paper markets and buying physical metal for delivery. Every ounce removed from the system is one less ounce the banks can use to cover their shorts. This is no longer just a trade or an investment thesis. It's become a movement. It's a financial revolution driven by people who refuse to accept a rigged system. Every time the banks cheat more blatantly, they prove that our analysis is correct. They prove that they're desperate. They prove that the fundamentals we've been discussing are real. They're creating a generation of investors who will never again trust paper promises or fiat currency systems. The long-term consequences of their short-term survival tactics are beyond what they can imagine. The banks want you to believe they're all-powerful. They want you to think they control everything and resistance is futile. But look at their actions objectively. The frantic midnight rule changes, the unprecedented margin hikes, the disabled buy buttons, the obvious spoofing on the order books. These are not the actions of a powerful entity in control. These are the desperate moves of a cornered animal fighting for survival. A truly powerful player doesn't need to cheat to win. They win on fundamentals and market forces. The fact that they're cheating so openly and desperately is the ultimate signal of weakness. It means they've lost control of the underlying supply and demand dynamics. They're trying to hold back an ocean tide with sandbags. They can delay the inevitable, but they cannot stop it. The dam is cracking in multiple places simultaneously, and they're running out of resources to patch all the holes. Each manipulation tactic they deploy weakens their position further and radicalizes more people against them. What we're witnessing goes beyond silver or commodities. This is the destruction of the entire concept of free market capitalism. If the rules can be arbitrarily changed whenever wealthy institutions face losses, then there is no market. There's only a rigged game where regular people are guaranteed to lose. This creates catastrophic moral hazard throughout the system. It tells the banks they can take massive reckless risks with unlimited leverage, knowing that if they lose, the rules will simply be changed to make them whole again, but it also destroys faith in the system itself. And faith is the only thing backing modern fiat currencies. Money works because people believe in it. Markets function because people trust them. By rigging the silver market, so obviously, they're undermining confidence in the entire American financial system. They're destroying the credibility that took generations to build. They're burning down the foundation of the economic system to save one building. The long-term cost of this short-term fix will be measured in the death of dollar hegemony. Despite all the paper manipulation games, the fundamental supply situation continues deteriorating. Silver mines are depleting at accelerating rates. Ore grades are falling, meaning miners have to process more rock to extract the same amount of metal. No major new silver deposits have been discovered in over a decade, despite extensive exploration efforts. The world is consuming silver faster than it can be mined from the ground. The above-ground stockpiles that took decades to accumulate are gone. They've been consumed by industrial demand. We're now eating into strategic reserves that governments accumulated during the 20th century. Those reserves are finite and running low. The banks can create infinite paper contracts with a few keystrokes. They can print silver certificates until they run out of ink, but they cannot print geology. They cannot manifest physical metal into existence through accounting tricks. The fundamental deficit is real, measurable, and accelerating. Eventually, industrial demand will overwhelm any amount of paper manipulation. When a solar panel factory has to shut down because it cannot source silver, when an automotive plant cannot build electric vehicles because electrical contacts are unavailable, the price will go vertical, regardless of what any exchange rules say. Much of the short selling occurring right now is happening in shadow markets that the public never sees. The over-the-counter market, where institutions trade directly with each other, is completely unregulated and unreported. These private trades don't appear in official data. The public has no visibility into how much leverage exists in these dark markets. Based on analysis of market behavior and leaked information from industry insiders, many experts believe the true short position is 5 to 10 times larger than official reported numbers. This hidden leverage is a ticking time bomb. As interest rates remain elevated and the silver price climbs, the cost of maintaining these positions becomes unbearable. We're approaching what economists call a Minsky moment, a sudden violent collapse of asset values caused by excessive hidden leverage unwinding all at once. When that moment arrives, the price movement will be unlike anything we've seen before. Despite all their cheating and manipulation, the underlying wealth transfer is still happening. It's just happening more slowly than the free market would allow. Every ounce of physical silver you buy and hold is an ounce the banks cannot use to cover their short positions. You're removing their collateral from the system. They're trying desperately to shake you out of your positions because they need your metal. They need you to sell so they can buy it back at lower prices and reduce their exposure. The volatility, the rule changes, the media attacks, these are all designed to make you doubt yourself and give up. Don't give them what they need. The volatility is simply the price of admission to this trade. The cheating is actually confirmation that you're on the right side. We're in the final rounds of a heavyweight championship fight. Your opponent is bigger and stronger, but he's also exhausted. He's fighting dirty, hitting below the belt, but he's wobbling. One more surge of pressure and he goes down. So how does this story end? It ends with the failure of the paper market system. It ends with the complete decoupling of physical prices from paper prices. We will see a black market develop, where physical silver trades at double or triple the official exchange price. Eventually, the official price will have to chase reality. That gap will close violently and suddenly. The banks will ultimately be bailed out by the Federal Reserve. The currency will be debased to pay for it. Inflation will accelerate. And the only people left standing with real purchasing power will be those who hold physical metal outside the system. The cheating we're seeing isn't a sign that the movement is over. It's confirmation that we're entering the terminal phase. They changed the rules because they're losing. They halted trading because they're terrified. They manipulate the price because they cannot control the fundamentals. They want you to sell. They want you to give up. They want you to doubt everything you know about supply and demand. But you've seen the evidence. You've seen the empty dealer inventories. You've done the math. You understand that the system is broken and physical metal is truth. Don't let them steal your future with midnight rule changes and paper manipulation. Hold your positions. Demand physical delivery whenever possible. Remove metal from their system. The era of unchallenged market manipulation is ending. The era of sound money and real assets is beginning. And you're on the right side of history.